You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, my co-host Sam Ball. This week on The Investor Way, we have DS Smith, Doc Martens, Pets at Home, Baltic, Halfords, and our US company of the week is Etsy. Sam, shall I kick us off with one of our favourite box makers?
Absolutely. Certainly in the top three.
Okay. So DS Smith had their half-year results out, with the group reporting an 18% fall in revenue to £3.5 billion, volumes dropping by 4.7%, but most of the revenue decrease was down to price cutting. Underlying operating profit fell 12% to £365 million, as lower input costs and efficiency gains partly offset the decline in revenue. Free cash outflow was £54 million, down from an inflow of £494 million last year. This was due to lower profits, unhelpful timing of cash receipts and payments, and a £103 million final payment to a previous acquisition. Net debt rose from £1.6 billion to £2 billion since the year end. The dividend was held flat at 6p a share. Going forward, management expects markets to remain challenging, but that volumes will be stronger in the second half. It also announced that the CEO, Miles Roberts, will be retiring after 13 years in post. His formal notice period will not start until December next year. Shares were down about 1.5% in the early trading. In terms of valuation, DS Smith has a market cap of £4.17 billion, and the shares trade at 8.8 times forward earnings, below their 10-year average of an 11.5, and they have a prospective dividend yield of 6%. I thought these results were a bit disappointing, even given the tougher market conditions. But overall, I would still say it's a well-run business, and it is still on the back of a growth trend with e-commerce and the move away from plastic packaging. Debt is at manageable levels. It's about 1.7 times cash profits. And hopefully, as we see the economy improving and inflation dying down, we will see a better second half. So I think at the current valuation, it is really baked in, but yeah, I think not as good as we've got used to, and obviously not as resilient. Sam, what are your thoughts?
Echo what you said. It's pretty disappointing. I'm surprised they've had to drop prices by as much as they have. 18% fall in revenue and volumes are only down 4.7%. So prices are down a lot. Yeah, it's really, really surprising. I'd have thought they'd have had slightly more pricing power than that, but I guess what they are selling is a commodity, but you'd have thought with the scale and stuff, they'd have had slightly more power, but I don't know, it's something that we've covered it for 2 or 3 years, and I've not really seen a set of results like this from them. It was a business that I've definitely quite liked, and I've liked the more we've covered it, but I wouldn't say I've ever considered buying it, but I would be much more put off by the fact that they have demonstrated a lot less pricing power than I thought. And maybe that was just slightly naive in that they are basically selling a commodity, so I don't know what I expected. But
yeah, I think we've always been slightly more surprised about how it's been valued, and it has always seemed on the cheaper side, even when it was delivering. And now maybe that was all, the market was always pricing that in.
Yeah, I knew it was a cyclical, but I thought it was the cyclical in the sense it would sort of rise and fall with the general economy. But I thought that would be more on the volume side. I didn't really think, I was surprised to see it impact pricing like that. But I suppose, if they're slashing prices to try and minimize the damage, it makes sense. But yeah, it's taken me a bit by surprise, but that might just be a bit of naivety on my part, because I don't know what they could have done to make their boxes unique. So there's always going to be some element of commoditization. Should we move on to
an
slightly
actual
more
brand.
Unique product?
Yeah, go for it. Doc Marten.
Yep. So Doc Martens, the business we've covered a couple of times before, they have come out with their half-year results, and revenue was down 5%, to 395.8 million, although in constant currency it was only down 3%. The direct-to-consumer revenue mix was up 7% from 43% of sales to 50%. EBITDA was down 13% to 77.6 million, and the EBITDA margin was down 1.6 percentage points to 19.6%. Profit before tax was down 55% to 25.8 million. Earnings per share was down 58% to 1.9p per share, and the dividends flat at 1.56p per share. They've said the revenue drop was primarily driven by weakness in USA wholesale, and wholesale revenue was impacted by planned strategic decisions to reduce volumes into Europe, Middle East, and Africa e-tailers and exit of the China distributor, together with a weaker US wholesale performance than previously anticipated. Regional performance is in line with expectations, with good growth in Europe, Middle East, and Africa, where revenue is up 9%. A strong performance in Japan direct-to-consumer, where revenue is up 41%, and America revenue is down 18%, which is driven by wholesale, as mentioned. They opened 25 new stores globally, and they said the drop in profits reflects the EBITDA performance together with higher depreciation and amortization as a result of continued investment into IT projects, distribution centres, and new stores. They said the £50 million buyback programme is progressing well. The number of pairs of shoes sold was down 9% to 5.7 million. And to expand a bit more on the wholesale revenue, which was down 17%, they've said, as previously announced, we took 3 strategic decisions which impacted wholesale revenues this year, but will create a strong platform for future growth. Firstly, we significantly reduce the quantity and range of products sold into Europe, Middle East, and Africa e-tailers in order to ensure scarcity of supply in the region and migrate sales to our own websites. Secondly, we see sales to our distributor in China ahead of the contract ending in June 2023. In the Americas, we work with 2 large wholesale accounts who had excess inventory, reducing shipments through the first half in order to right-size their inventory positions. In addition to these strategic decisions, we also saw industry-wide destocking among USA wholesale customers. In terms of the valuation, business trades at a market cap of 889 million and trades at about 9 times earnings with a dividend yield of over 6% now. I didn't remember the valuation being this cheap the last time we looked at it, and the reason is because it wasn't. So we've covered Doc Martens pretty much since they listed. In the past 2 years, they're down 77%. In the past year, they're down 52%. In the past 3 months, they're down 40% and 25% down in the last month. I'm not sure how I feel about this. The revenue drop is disappointing. It might be the way management's spinning it, but I feel like if they're deliberately sacrificing revenue because they want to prioritize the direct consumer, I don't necessarily have an issue with that because I think longer term that's better for them. I don't think the results are awful. It's only a slight drop in revenue. But if they can get that revenue shifted over to direct to consumer, I would consider it to be higher quality revenue, and it would certainly be higher margin revenue. So I think these results are disappointing. I think we probably need to wait and see as to whether the strategic decisions they've made actually pay off. But on the surface, I don't think these results are terrible when you take into context the strategic direction they're going into. And also stuff like the US wholesale does look to be temporary. You know, and if they're stopping discounting and stuff, again, they're sort of maintaining the quality of the brand, which I don't necessarily disagree with. So I think they're making a lot of right decisions in the long term. In terms of the price, this is a business that we've covered when it was 4 times higher. And we kind of said, well, where's the growth and stuff? But I think if you believe in the decisions that management are making, and they don't have to grow like gangbusters, but if they can just have, you know, a small amount of growth, I think at 9 times earnings and a 6% dividend yield, I actually think this looks quite attractive now. John, what do you think?
Yeah, it's funny. Funny you say that, because I think, yeah, if you believe in the brand and you think that has the potential, and they are doing this big shift to direct to consumer, and it's significant at the moment, 50%, then actually you can see the value in it. And at 9 times earnings is not expensive. I know the 9% fall in volumes and the revenue down a bit is disappointing, but I think there are positives to see in it. Yeah, probably not one for me, but I like it a lot more now looking at it, and I suppose what management is doing, than I did when it first listed and there was all the hype around it. But I guess the shares are down 75% or whatever they are, so it is very different.
I think because this is the first half we've seen like this, and this is the first time we've seen it at a price where it actually looks fairly attractive. I think I'd need to see how it played out. I'd need to come back and look at it in another 6 months. I wouldn't buy it on the back of these results. Whereas if you see, even if they're not growing, but if revenue sort of stabilizes in the next 6 months, you see that, say the direct consumers continuing to be a higher proportion of sales, the margins going up. Yes, you might have to pay a little bit more for it than you can get it now, but you can see that actually a lot of the decisions that they're making now are starting to pay off. Yeah. And it's down so much, you can probably still get it very cheaply if you want to. So I don't think it's quite a watch list stock for me yet, but I think if we come back to this in another 6 months, it could be.
Yeah. And then the other thing to say is it is on the background of a period where consumer discretionary spending has been squeezed. So it could account for quite a lot of that.
But it is a quality brand though, and I think at a price it probably is a brand that I would quite like to have. I do still think that in sort of 20 years time, 15-year-old girls will be walking around Manchester in Doc Martens. It's just the way of the world. I think one thing they could do is maybe try and find lower quality providers of the shoes, but because everyone you speak to with Doc Martens, they've had them for like 7, 8, 9, 10 years.
Yeah,
I think a lot of these customers, they're customers for life, but they're not buying many pairs.
Yeah,
but I guess that's what the brand is, though. It's going to be a very, very high quality set of shoes. But
so you're suggesting that they make them to maybe last 2 or 3.
Well, if they lasted 5 years, people would be replacing them sooner. But that's still very good for a shoe that you're basically wearing every day. They don't need to last 10. People won't be that annoyed. But I think that is a bit tongue in cheek. I think they have obviously built the brand on the fact that the fact that like everyone you speak to has had the Doc Martens, they have had them for a very long time, and it's good in the sense that it's a high quality brand, but you're not going to be buying a new pair of Doc Martens every 2 or 3 years. They're just not that kind of shoe. But
no, okay.
It's a good brand and one I'd like at the right price, I think.
Fine. So next company we have is Pets at Home. They had their half-year results out, and Pets at Home had the group reported half-year revenue of £774.2 million, reflecting like-for-like sales growth of 6.2%. And the retail operation grew by 5.2%, despite some disruptions over the period due to the launch of its new distribution centre and digital platform. The smaller vet group division saw record sales. Underlying profit before tax fell 19.3% to £47.8 million, impacted by the higher logistic costs and investment in the brand relaunch. Guidance for the full year is unchanged, looking for underlying pre-tax profit of around £136.8 million. And free cash flow fell by 44.3% to £23.1 million. The balance sheet retained a net cash position, including leases, of around £12 million. The group declared an interim dividend of 4.5p a share, with the first half of its £50 million share buyback completed. The shares were broadly flat on the results. In terms of valuation, Pets at Home has a market cap of £1.47 billion and trades at 12.7 times forward earnings, compared with a 10-year average of 16 since listing, and has a prospective dividend yield of 4.8%. I thought these results were reasonable, particularly in the current market conditions, and the group has been investing in the brands, in the new distribution centres, and the improved digital side of the business. What I also noticed was that they're doing well with the VIP members, topping 8 million. So it's a similar model to Tesco Club Card. And they increased puppy and kitten club membership, and critically increasing the number of customers who buy both a product and a service, boosting overall sales in the longer term. But it is still very early days with this. And as we know, the vet group division it's all record sales, but it's a much smaller part of the group. I suppose one criticism might be regarding saturation level after the COVID pet purchasing spree. But I think the group still has a lot to tap into regarding the services and the veterinary care. It's clearly part of the strategy and it is beginning to do that. I don't think it is particularly expensive at 12.7 times forward earnings, but I don't know whether it will be the first company I go to. One of the ones that I'd liked the more that we've covered it. I think these results are more lackluster compared with what we've become used to. But it seems like a very well-run company, and I think following the right strategy. So yeah, stays kind of around the watch list for me. Sam, what are your thoughts on these results?
I think the results are all right. They're not amazing. The revenue growth is okay. The profit drop I don't really have an issue with, because if they put money into the brand relaunch, if they're investing back in the brand and stuff, I don't really have an issue with that. So that's obviously just a bit of a one-off blip. It is a good business. It's done very well. It's at a pretty reasonable valuation. It's lower than the average PE since listing, but I think that's partly because you're sort of looking around and thinking, well, it's not going to go international. What more can it actually do? And it's a really well-run business, but I think it is it's probably pretty saturated. I think it's done really well. I've been surprised by how Amazon-proof this business has been. If you'd asked me sort of 5-6 years ago before we started covering it in the show, before we started looking at these figures sort of every 6 months, I wouldn't have expected it to be a business that's doing as well as it's doing. I would have thought Amazon must be absolutely murdering these guys. And that's just not the case. And I think it's a really well-run business. I think it's a quality retailer, but I just don't, the dividend yield's pretty good, but I just don't think I pay 13 times earnings for it when I've got question marks over where the growth actually comes from. I think you'd have to buy it with the assumption that it's just going to grow in line with inflation and that's it. And if they can do anything else, it's a bonus. And I just don't think it's really priced for that, which for me, it would need to be.
What do you think about pinning things on the services and the veterinary?
I think I think it makes sense. I think obviously if you've got someone who has say a kitten or a puppy and you've got them as a customer all the way through that dog or cat's life, that is worth a lot of money and it's worth investing in that. But then I don't know what the proportion of pet owners is that shop at Pet at Home, but if they've already got 8 million VIPs, eventually you do just start running out of people that are willing to spend that much money on their pets. And I don't know if they get into that point. We might be sat here in 3 years' time, they've got 16 million VIPs and the share price has skyrocketed. But to me, it doesn't look obvious that that's going to happen. It's kind of like if they were at 1 or 2 million, it's a very different conversation. But I think 8 million, it's a fantastic number. But it's also getting to a point where when you look at the size of the UK population and the size of the number of pet owning households, they've got a lot of them already.
Yeah. Fine. Okay, then on to Baltic.
Yes, so Baltic Classifieds Group, it's a business we've covered a couple of times before and one that we have liked. So for anyone who's not familiar with Baltic Classifieds Group, they are listed on the FTSE 250. Not really sure why. Probably because it'd be harder to list over in Baltic stock markets. They are a group which basically have the Auto Trader, Rightmove, and probably like Craigslist / eBay of the Baltic countries. So they have come out with their 6-month results for the period ended 31 October 2023. And auto revenue was up 28% to 13.7 million. And these figures are all in euros, by the way. Real estate revenue was up 20% to 8.8 million. Jobs and services was up 18% to 7.1 million, and generalist revenue was up 9% to 6.3 million. So overall revenue was up 20% to 35.8 million. The EBITDA was up 22% to 27.8, and the EBITDA margin was up 1% to 78%. The operating profit was up 36% to 19.4. However, the adjusted figures were up 23% to 27.5. The reason the adjusted operating profit is so much higher than the operating profit is the amortization of acquired intangibles. So it's basically if they bought brands or other businesses, they can write off a part of that purchase every year through the profit and loss. But really, it's not really a cash cost. And if they've gone and bought, say, the right move of Latvia, there's a strong argument that although they get the write-off every year, which is affecting the operating profit, although they're getting that write-off, there is a strong argument that the brand might not actually be worth any less, even though they've had to write some of it off. So I think in this case, the adjusted operating profit figures are probably the ones you want to use. Adjusted net income from the period was up 20% to 22.7. Earnings per share was up 34% to 3.1 cents. And adjusted earnings per share was up 22% to 4.6 cents. Net debt fell by 8.4 million to 36.9 million, and that's down from 45.3 million a year ago. And they ended the half with leverage at 0.7x, and that's down from 1x a year ago. Gross loan balance decreased to 55 million from 70 million. Cash generated from operations grew 21% to 29.1 million, with cash conversion maintained at 99%. Interim dividend was up 25% at 1 cent per share, having already returned 7 million through ongoing share buybacks and reduced gross debt by 15 million in the reporting period. So in the auto market, which is basically their equivalent of Auto Trader, in Lithuania, they're 8x bigger than their next biggest competitor, and in Estonia, they're 39x bigger. They don't have something for Latvia, so I'm assuming they don't operate in that market. Real estate, so that's the right move. In Lithuania, they're 21x bigger than the next biggest competitor. Estonia, they're 17x bigger. And then in Latvia, they're 0.6x the size of the number one competitor. In the jobs market, they're 0.8 of the biggest competitor in Lithuania, and then they've got no comparable data in Estonia and Lithuania. I think that means, rather than they don't operate, I think that means that they don't actually have a significant nearest competitor. And then on the shopping one, which is kind of on like the Craigslist / eBay, they're 23x bigger than the next competitor in Lithuania, and they're 0.3x the size of the next biggest in Estonia. It does seem like most of the opportunities probably in Latvia. It does seem to be the one Baltic country they've not got absolutely nailed down. In terms of monthly visits per capita, and this is for the 2020 calendar year, Auto Trader got 0.4 per month in the UK, and Rightmove got 1.3 per month in the UK. Baltic Classifieds Group gets 6.5x per month. Now, they offer more stuff, but in the Baltic countries, people are going on there more than they are in Rightmove and Auto Trader in the UK, which is quite good. They've also posted the macroeconomic overview, and between 2000 and 2022, the average EU growth rate was 1.2%. However, Lithuania's was 4.9% for GDP per capita. Estonia was 3.6% and Latvia was 4.3%. So they're all well above the EU average. Public sector debt is not really relevant to Baltic Classifieds Group, but it's again, public sector debt as a percentage of GDP is lower than the Euro area average. Euro area average is 89% of debt to GDP, whereas Lithuania has 38%, Estonia 19%, and Latvia 39%. I don't know if that's because they're well run or no one wants to lend to them. Inflation is above the Eurozone area in all three of the countries. Wage inflation is higher, which I guess is good if you're on a job platform, and unemployment is about the same as the EU average. In terms of valuation, the business trades at a PE ratio, adjusted PE ratio of 31. I think these are a fantastic set of results. I don't think you can really knock them. I think there's probably still a lot of opportunity there when you look at how much these countries are growing above the EU average growth rate. I also think there's an opportunity in Latvia where they don't seem to have as much of the market locked down as they do in Lithuania and Estonia. And yeah, hopefully it would be a case of as these countries develop more and more, Baltic Classifieds grows with them. My concern is it's expensive. And I don't know how big the Lithuanian, Estonian and Latvian markets can actually get in the long term. It's a business that I really, really like. I would love to own this, but when I've got questions over the size of the market, I don't think I could justify paying 31 times earnings for it. But we've been covering this stock about a year now, and I've sat on the fence in that time, and let's see what the stock price has done. Because it's the thing is, it's absolutely put the numbers up, but then the problem is the share price has gone up with it. So yeah, in the last year, it's up 56%. So I was probably sat here a year ago complaining it was too expensive, and it was still 30 times earnings, and it's still getting the figures. It's putting the figures up. But for me, it's the kind of business I'd love to see on sale at 50% off, but I don't think I could pay 31 times earnings, but it's a really, really good business and I really like it. John, what are your thoughts?
I think similarly, definitely, well, results fantastic, but it's expensive. And again, like you say, not knowing the markets that it's operating in very well, it's difficult to say whether that's, I suppose, fairly valued and that the room left for growth. I don't know. I probably wouldn't be brave enough at the moment, and yeah, it may be a missed opportunity, but it's pricey.
Right, should we move on to a cheaper business?
Oh yeah, I mean, I can tell you now, I'd take Baltic over the next one, but Halfords, it had its half-year results out. It had reported half-year revenue of £873.5 million, which was up 8.3% on a like-for-like basis. The auto centres business grew the fastest, with sales up 18%, as non-discretionary categories like retail motoring and servicing driving performance. Group also gained market share across all of its business divisions, and underlying pre-tax profit grew 15.8% to £21.3 million. This was helped by strong top-line growth and good progress on its cost-cutting programme. Free cash outflow increased from £0.1 million to £19.2 million due to an increase in inventory and unfavourable timing of payments. Net debt, including lease liabilities, rose from £336 million to £372.3 million. Full-year underlying pre-tax profits are now expected to be between £48 and £53 million, at the lower half of the previous £48 to £58 million guidance. An interim dividend of 3p a share has been announced, which was in line with last year, and the shares were down nearly 20% in early trading. Group has a market cap of £428 million and trades at 11 times forward earnings, with a prospective dividend yield of 4.7%. The group spent huge sums on acquisitions over the past few years, moving into the auto centres business, and net debt is now at an eye-watering £372 million. They did manage to increase sales by 18%. However, I do think in the longer term, with the move to electric cars, with fewer serviceable items, and the trend towards people going for PCP with servicing, doesn't help the long-term investment case for Halfords. Obviously, it had a great COVID and everybody was going out and buying bikes, and we saw the share price rocket on the back of that. But that's all now dried up, and this strategy to move into auto centres, well, the headline figures aren't terrible, but I think longer term and with all of the debt, I wouldn't touch Halfords, in short. Sam, do you see any green shoots here, or do you still think it's an uninvestable business?
I think the growth's decent, but then a lot of that growth hasn't come from the big ticket items they'd want it to, which is why you're not seeing it feed through into profits. I think the club memberships is pretty good. So the Motoring Loyalty Club, they've gained 1.2 million members in the previous year, and that's now up to 2.9 million. So that's pretty fast growth. The debt is concerning. Half year profits, pre-tax profits were 21.3 million. The debt's 300. So it's, and if we take the highest profit they've achieved in the last 5 years, 77 million, and then it's been cut in half the next year. But then with liabilities of 372 million, the debt's that's using the best figures they've put up in the last 5 years, and the debt's almost 5 times the profits. And as a rule, sort of once it gets over 3, I start to get a bit uncomfortable. But if it's a good enough business, I don't mind it. Once it gets over 4, it becomes pretty uninvestable for me. And this is close to 5, and that's with profits that they're probably not going to come near this year. It could end up being 6 or 7 when we've got the full year profits, and that that is reflected in the share price, 19% down. They've gone big on this strategy where they've taken a fragmented market and they're sort of trying to dominate it. And thus far, it's not feeding through into profits. It's feeding through into sales, but not into profits. But I don't know. I think maybe the Loyalty Club membership does offer a glimmer of hope, but I just think long term, I think it's not really a business I'd want to be. And then they've got all this debt and they're still paying a dividend. I know we talk about it every time, but it does just annoy me. I think when your debt is that concerningly high, just slash the dividend to zero. If you've got a strategy that's reliant on acquisitions, slash the dividend to zero and use that to fund it or part fund it. But yeah, when they're borrowing money, interest rates are going up and they just pay it out as a dividend, you do question some of management's decisions. And if that's how they're allocating the dividends, that's just one element of the capital allocation, but it does make you question some of the acquisitions as well. But yeah, I wouldn't touch it, but I think there's maybe a glimmer of hope in the loyalty program. That those figures are genuinely quite impressive, even if they've been, basically acquired rather than actually organic.
What about our US company of the week?
So we have got Etsy this week, which is a business we have covered multiple times before, so I'll assume we're all familiar with it. They have come out with their Q3 results, and gross merchandise sales, which is the total value of everything sold on the platform, was up 1.2% to 3.039 billion. Revenue was up 7% to 636 million. Gross profit was up 6.5% to 447 million. Operating expenses were down 74% to 358 million. Net income was, it was a loss last year, so you don't really have a comparative, but net income was 87 million. The net income margin was up from 162% negative margin to 13.8% positive. Active sellers was up 19% to 8.8 million. Active buyers was up 3.4% to 97 million. The percentage of sales coming from mobile was up 1% to 68%, and outside the US, that figure was up 2% to 45%. They've said growth in active buyers accelerated again this quarter with a 4% year-over-year increase, setting a new all-time high of 92 million. United States active buyer trends returned to modestly positive year-over-year growth for the first time in 7 quarters, and international active buyer growth remained strong. We reactivated 6 million buyers, up 19% from the prior year period, and acquired 6 million new buyers. Our retention of active buyers improved from the prior year and remains above pre-pandemic levels on a trailing 12-month basis. While gross merchandise sales per active buyer on a trailing basis declined 6% year over year to 127 in the third quarter. Trends in this metric continue to show signs of stabilization on a sequential basis. I have to say this is a metric I'm not too worried about because I think it's just fallen with the general economy. Our number of habitual buyers was unchanged on a sequential basis at 7 million, an encouraging sign of continued stabilization in this metric, due in part to strength in Germany, France, and several non-core Western European countries. And in the slides, they said that over 75% of their sales come from the top 4 categories, which is home and living, jewelry and accessories, apparel, and craft supplies. In terms of the valuation, the business trades at a PE ratio of 34. However, it only trades at 15x free cash flow. The shares have done pretty well since we last looked. When did we last cover them? It was probably only a couple of months ago, but they were about 65. They're at $85 a share now. However, the valuation hasn't really changed. It's still about 14 times free cash flow. So, yeah, as a shareholder, I'm very happy with it. I think these are an excellent set of results. I think most of the numbers are moving in the right direction. The only one is basically the sales per customer, but I'm not really too worried about that given the state of the economy. I think Etsy is the kind of thing you will pull back on, but the fact that they're increasing the buyers and the sellers, yeah, I think it's really positive, and I'm very happy with this quarter. John, as a non-shareholder, but someone who's been tempted in the last few quarters, what do you think?
I have a bit of FOMO, and I think they're very good results, and it's obviously going in the right direction. Not as certainly not as expensive as it used to be. I think it's probably kind of fair value actually. So yeah, still on the watch list, and see whether I'm brave enough to pull the trigger soon.
Maybe next time.
Well, if it's anything like last time, I should do it now.
Well, yeah. Of the 6 businesses then that we've covered this week, DS Smith, Doc Martens, Pets at Home, Baltic Classifieds Group, Halfords, and Etsy, which do you like the most and which do you like the least?
I mean, the least is Halfords, which I like the most. I mean, I like both Baltic and Etsy. I suppose it comes down to the valuation to some degree. I probably, with my money, I'd go for Etsy.
without being boring, I'd do exactly the same. So I think Halfords is an easy bottom this week. I do really, really like Baltic, and I'd love to own it, but I just think valuation-wise, Etsy does top it. But I top it. But I think Etsy is also a very good business. But Baltic, it is a business that I would definitely like to own if I could get it at the right price.
Yeah, and I mean, that being said, Doc Martens now it's really fallen in value. It's a more interesting prospect, I think.
I think it is, yeah. I think if we cover it in 6 months and it's at a similar valuation and sort of, more revenues shifting over to direct consumer without other metrics dropping off significantly, I think it is quite positive. Potentially could be interesting, but I think it's too soon to tell at the minute.
Yeah. Well, thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.